Good morning. I'm Layan, Odeh, Canada's investing reporter at Bloomberg News. Thank you for joining us. I'm pleased to be joined by Andrea Dore, Head of Funding, Capital Markets and Investments at World Bank Treasury, Jim Hopkins, Assistant Deputy Minister of Provincial Treasury for British Columbia, and Andrea Delgado, Lead Funding Officer at Inter-American Development Bank. Thank you so much for joining us today. How do you view the credit space? Because fears of a recession widen the spreads, but we're still getting conflicting messages about the economy. On the one hand, unemployment rate is low, consumer spending is high, but on the other hand, consumer sentiment is near a record low, and interest rates and inflation are rising. So how do you view the credit market at the moment?
Well, I could weigh in on that, Layan. You're quite correct. The central banks are facing mixed signals, but it's also clear that they will not tolerate inflation at multi-decade highs, and will aggressively tighten monetary policy, and even if that means a recession. Deleveraging and recessionary fears, I think, explain the current inversion of the yield curve. And I believe that it'll probably continue well into 2023. There are several factors that I expect will conspire to keep rates higher for longer and credit spreads wider, modestly wider into 2023 and 2024. Inflation, I expect, will be very sticky as the economic impacts usually lag. The impact of deglobalization and supply chain disruptions will take some time to stabilize. The impact of Ukraine is destabilizing and putting pressure on inflation. Geopolitical factors curtail calm in the credit markets. Liquidity challenges in the US Treasury market from tightening of monetary policy is another headwind on credit spreads going forward.
And Andrea, what's your view on that?
Yeah, I guess the market, despite that level of, obviously we have a significant amount of market volatility, but deals are still getting done. I think that level of volatility will continue unless there is some direction in terms of what the terminal rate will be. And also some sort of market consensus or direction as to whether inflation will continue to go up. But that being said, and we've seen spread widening, but like I said, the market is still very resilient, and we've seen a lot of trades being done. In fact, if you look at in terms of volume, from even the US market, September, we have seen the highest volume, the second busiest month for the year. You look at, for instance, the Euro market, you'd see that in August as well was probably the busiest funding period for investment grade assets in the last 6 months. So I think despite all the conflicting messages and despite the volatility that we've seen in the market, we've seen, the market is strong and deals are getting done.
And Andre?
Yes, we see a very similar story as Andrea just mentioned. There is a continued strong demand for the bank financing. And of course, we keep observing the evolving situation in Ukraine and also the global inflation phenomenon, which has, of course, an impact in our region, the Latin American Caribbean region. And also the pace of interest rate normalization is another factor that would just add to the volatility. And in such instances, I would say that for Tier 1 SSAs, to some extent benefits. Of course, there is a widening, but deals are still continue to be done. And there is, to some extent, a little bit of flight to quality, if you will. And there is a expected pressure from credit ratings to some of our borrowing member countries because of the commodity volatility. And the commodity prices, they affect the countries in our region, again, Latin American, Caribbean, I'm talking about. in different ways, depending on if the country is an importer or exporter of oil, and if it is an importer or exporter of certain commodities, etc. But I would say that opens opportunities for financing there in many topics, including, for instance, nearshoring. So that would be one of the topics that could potentially be of a hot topic in 2022 and to some extent in 2022 as well. So we continue to see high demand for the bank's products, and high commodity prices is overall expected to have a positive impact for government revenues in exporting countries. But on the other hand, the high oil prices will negatively impact importers, and that would perhaps be the case for Central America and the Caribbean region.
I want to go back to what you mentioned about the deals. So why do you think that the deals continued unabated? Do you think it's because they already priced in the interest rates, or or is it because they're expecting further hikes and they just want to issue bonds before they accelerate?
Well, we have seen unprecedented volatility in the U.S. Treasury markets, in swap spreads as well. But not so much in SSA spreads. They did widen, that's for sure, but to some extent, to a smaller extent than other potential credits. There is a lot of uncertainty regarding the path and the pace of central bank actions, and that's the main thing at the moment that has been impacting spreads. So I was talking about unprecedented volatility, and in the past, not so long ago, it was rare that we see like a day that we have a 10 basis points impact in the US Treasury markets. And nowadays, it looks like it's much more common. And that just tells you how much it is volatile and how much of a special case it is until such time when the central banks reach their final goal in terms of their target interest rates, and also the market stabilizes as a function of that.
So, Andrea, why do you think the deals are still continuing?
Yeah, in our space, we're a very strong AAA NIM. And in times of uncertainty, in those type of market environment, we tend to see a flight to quality. And so that's one of the factors. We're able to provide investors with a high quality, safe haven asset. So we've seen that increased demand. There's also a lot of liquidity in the system that needs to be put to work. So you have that combination as well in terms of the amount of liquidity. If you look at year-to-year issuances, despite that we've seen increased volume in August, year-to-year issuances is down. So you have that combination of, there a lot of redemption, significant amount of redemption. So you have high amount of liquidity in the market as well. Now, obviously, there are a lot less issuance windows now. And so that also poses a challenge. But I think part of it, and as Andre mentioned, in terms of the widening spread, but relative to the other asset class, if you look at probably post May, you'd see on average spreads widening around at least 15 basis points. That have come down, and you see the average spread maybe in the range of 5 to maximum 10. We were just in the market last week, and we were able to do a couple significant size trade, and the new issue premium was just a couple basis points.
So do you expect the spreads to widen again more, or do you think that investors already priced in the interest rate hikes and as well as the inflation?
No, I would have hoped that investors, and that's what I thought even last week, when inflation numbers was just marginally higher than market expectation, but yet still we saw so much volatility in the market. Double digit at one point, we saw like 15 basis points move in the spreads. So I and before a marginal change in inflation would not have had such an impact on the market like that. So I think it's a broader picture. It's not just inflation, the whole backdrop in terms of the geopolitical backdrop. There are a number of other factors, and it's not just inflation. And now what we're seeing that every piece of data moves the market. Data that would not have even been looked at, you'd not even focus on before, move the market. So it's very difficult. I wish I had a crystal ball in that regard, but it's very difficult to say whether that we expect to see spreads continue to tighten. But what we have seen, like I said, the market is still very, very robust, and we've seen spreads actually come in in terms of our asset class as to where it was a few months ago.
Jim, do you also what's the view for you from British Columbia?
Well, I would agree with Dore and Andrea on a number of points. But I think the stabilizing factor for investors in this SSA space is that there is a strong flight to quality, and the entities that comprise the top tier SSAs are responsible and are responding in a stable, predictable way. We are here for the long term, very, very, very long term. And this is an episode in the capital markets, which is perhaps a little disturbing to the extent that interest rates have spiked at the rate at which they have. They're probably unprecedented since the early 1990s, have interest rates moved as quickly as they have. But as I say, well, for example, in the case of British Columbia, our response is to stick to a fiscal plan, which is easily understood and transparent, and to give investors the confidence that we will turn the situation into return it to a stable one, and it's not cause for undue concern. I do think that probably inflationary news has still got more legs to it into 2023, and that may be unsettling. But again, I think well, as I say, in the case of British Columbia, we're managing a fiscal plan that will mitigate anything that would be fundamentally disruptive.
So how do you think the decompression of yields? How do you think? How is it impacting your organization and the funding? How are you managing?
Well, quite well. As I say, there's a couple things to it. We're managing very well. It's not a concern. We have experienced spread widening for sure, 15, 20 basis points. But we have been fortunate that we have been able to perform in line with, well, we've been able to deliver spreads which are pretty much stable as a percentage of the underlying, and materially lower than other provinces in the offshore markets. Our approach is a fiscal plan, a plan which has a lot of contingencies built into it, so that as the economy does improve, and I should say the economy has improved quite significantly. Our growth now is 6%. But as the economy does improve, we're able to perform to the upside, and I think that's what investors want to see, and that's what they appreciate with a AAA rated entity. In the case of British Columbia, we are a split AAA, AA plus entity, but we are showing signs of improvement in our income statement and in our balance sheet. And debt, actually, our debt burden is the most affordable of all Canadian provinces at only 3 cents per dollar. debt service cost as a percentage of revenue. So it's all very manageable. It's just probably the headlines are unsettling sometimes, and the propensity to dig into every piece of data that comes out has sparked this sort of volatile reply, which sometimes can be unsettling, as I say, but fundamentally, I think that's the important picture, is fundamentally the markets are remaining in good shape.
And Andre, do you have anything to add to this?
No, in the case of the World Bank, specifically IBRD, the yield decompression does not have any impact on our balance sheet. The reason being is that we have a floating rate balance sheet. So basically, all or most of our funding that we do in the market, we swap it back to dollars. So we have a dollar balance sheet, swap it back. So de facto, our balance sheet is immune in that regard. So, however, what we have seen in terms of the decompression of yield, particularly in currencies where we have seen negatively yielding currencies in the past few years, this normalization of yield is helpful. Yeah, because we have seen there are a number of investors in some cases that are unable to buy negative yielding assets. So now with yields normalizing or becoming, it has fully normalized, but at least trending, if you take, for instance, euros trending in positive territory, we've seen that as a positive effect for us.
And Andre, is it this similar at the Inter-American Development Bank? Do you think that the impact has been positive?
Yeah, exactly the same. IADB also has very strong and robust risk management policies and liquidity management policies, and same as the World Bank. Our funding is based on dollar floating rate in SOFR, and the funding and also the financing. So in that sense, the level of yields does not have an impact at all in our balance sheet. It does have, to some extent, an impact on the borrowing member countries, because they would now, of course, even if they pay SOFR, and to the extent that the SOFR rate is increasing, they would pay a higher cost for their loans. Yet I would say that historically, we are still at a very low interest rate levels. So perhaps the countries and the borrowing member countries had a benefit until recently of very, very low rates. And again, we have policies to manage all that, and even a compression or any change in the ratings of our borrowing member countries will not change our envelope, our ability to lend to those countries, since we have a very large and strong capital buffers to weather that. So basically, the short answer is there is very much no impact in our balance sheet, simply because every financing that we do is swapped back into US dollar floating rate. And virtually all our funding is also in US dollar floating rate as well.
So, Andrea, would you talk us through the impact of the current market conditions on your strategy or your funding strategy for the World Bank Treasury?
But from a strategy standpoint, I think the key thing is the increased level of volatility. Okay. I mentioned earlier what that means, what that translates to. There are fewer windows. The funding program for many of our peers has increased given the multiple crises that we have seen over the last couple of years, coming from COVID now to the war in Ukraine. So we have seen multiple crises, and the funding program, because we fund development loans in the developing countries, and those countries are the ones that are most hardly hit during the crisis. So volatility, coming back to your question, there are fewer windows, there are more issuances, and the ability to move quickly. Also providing investors with products, being investor driven. And one example was that last week we were recently in the market, and we did one a first of a kind dual tranche floater SOFR 4-year bond and a fixed rate 7-year. And so taking into consideration and looking at the maturity mix is important. And we saw there were some investors that were very defensive and wanted to stay on the shorter part of the curve in an interest rate increasing environment. Floating rate assets was more suitable, or that's what we saw greater demand for. Whereas you had other investors that were looking for fixed rate assets. And we saw, given the shape of the yield curve, obviously up to 7 years was what we see as the maturity in the fixed rate side that had the deepest demand. So in terms of strategy, our strategy remained in terms of being investor focused, flexible, but with the increased volatility, it just means that we need to react and adapt to the changing market environment.
And Jim, did you change your strategy in any way at British Columbia, or is it the same?
Yeah, fundamentally, it's the same. And, I harken back to what I said earlier, is that what you'll see the province do in the capital markets is what you've seen us do in the past. I think that continuity is welcome from investors. In our case, is to produce fiscal plans which generally perform to the upside and keeps debt affordable, keeps the debt burden affordable, holds on to our very strong credit rating, which we put a lot of value on. We know investors do as well. It's also, we also want to maintain a long-term welcome mat in the capital markets. And so you'll see the province diversify outside of Canada into US dollars, into euros, Aussie dollars. And we also have a track record of going beyond into renminbi, onshore, offshore, Miscela bonds. We put a lot of value on diversification, and we'll continue to do that, because I think that helps the province with assuring that it does have a welcome mat around the world to ensure it's financing its essential services. The other thing that we'll do, and this is no different than we've done in the past, is we'll continue to price, size, and time our offerings for performance. So that's, I think, very important for investors. I think maybe the only change that you might see from British Columbia is that we will mix in shorter dated financing, given the shorter dated term financing, given the rise in interest rates. So whereas before we're largely 10 years and longer, you might see British Columbia do a bit more in the 3 to 7 year term.
Okay, and just because we're running out of time, I wanted to ask Andre at Inter-American Development Bank, have you seen changes in interest in ESG issuances?
Yes, we have seen a renewed interest and an increase in the interest from the part of investors for ESG-related products. In our case, we do issue bonds in SDB format, and we also issue I-bonds, which is our social framework. I-bonds they finance projects in education, youth, and employment, hence the acronym. And we did see an increase, but that was a trend that has been probably starting earlier, even before the pandemic, perhaps, that investors have been more conscious in terms of being socially responsible. And in terms of our funding strategy, also no big changes. We continue to, of course, service those investors, and sometimes we see now the investors also coming back to the long end part of the curve. IADB also issued a 7-year bond 2 weeks ago, and that was a highly successful issuance with lots of receptivity, and that was done in SDB format. So it did attract a lot of investors' interest. So that's testimony that investors are focused, and they seem to be moving towards being more focused on ESG-related products.